Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, September 12th, 2022. It's 10:58 Eastern Time, 10:59 Eastern Time now as I'm starting the video. And what I'm going to do is overview of the equity markets. Won't spend too much time, but I'm going to cover some charts that I always touch on from time to time, and I haven't updated in a while. I'm going to cover some sentiment charts real quickly. And big picture here, we'll start out with the S&P 500 and the markets, and then I'm going to do updates on the other things I've been highlighting recently, the other trade ideas. Crude, natural gas, precious metals, that's gold, silver, and Forex, that's the dollar and the euro. We'll hit on those, and lumber. And today's a great example of what I harp on all the time, and that is diversification, diversification, diversification. Every bit as important in active trading and swing trading as it is in investing. Not just diversified among different positions, but asset allocation as well. And today, again, is a great example of that. I'll get to that in a second. Well, we're starting out here. This is a weekly chart of the S&P 500. You can see these, I talk on them all the time. The 200-day moving averages, both the exponential and simple. When you put them on a weekly chart, you want to use a 40 period because there's 5 days in a week, so 5 times 40 is 200. They're the same moving averages. You just have to set it on a weekly chart to 40 period. And it does a great job of defining bull and bear trends. And once the markets are clearly below those, once they've taken them out, that's a clear breakdown, they act as resistance. And I highlighted that just a few months ago when we had a rally back to the 200-day on simple moving average on the S&P 500. Now, you're looking at a chart. It looks familiar, right? But guess what? This was actually over a decade ago. Down here, that's 2008. That's the top of the last, what I consider the last bull market that we had. We've been in a bull market since '09 when the S&P bottomed. But you can see that's just what happened back then. Because if I go forward here, which I'll do, let me grab this little thing. You can see from that point, that was that back test. Once we clearly took out, we're clearly on a weekly basis. These are weeks. Each candle is 1 week. Taking it out, you back tested it, and then you came up for another near test, and then the bottom fell out of the market, and the bear really got going at that point. And remember, it was a 55% drop, 56 I think on the S&P from high to low, and then when you took them back, and you can see since then. This is, well, here's where we're going back to. Once we took them back, they tend to act as support, and there were times it went below, and each of those times, again, it was not that they were whipsaws. That was a 24% drop right there from the highs, actually 22.5. And so we've taken them out a few times since that big fourth quarter drop in 2008, but you recovered them. COVID, you certainly took them out, and then you recovered. And most recently, just like back then in that previous bear market, you came up, you rallied to it, you took it out there, and then you had to clear. This was more of that was a few weeks, and you were a little bit below it. This was when you clearly took it out, and then back test. Either way, you took it out here, and then what you do is you short. If you believe that there's a more downside to come in a bear market and it's not just a correction, then you short rallies back to it. So I just wanted to make that clear that we're below the 200 days, solidly below that. We're below quite a few trend indicators, and as such, I'm very open to the possibility, as I was before we even got there, that a rally back to the 200 would be the rally with the next leg down in the bear market to come. So therefore, and that's why I'm doing this video now. We're up today, and I just know that there's at least a decent percent of people listening to my voice right now that think, how can you get bearish now? Price action's been nothing but bullish lately. That's just bear market rallies. And look, if these things start to get taken out, I will change my tune. If I start to see solid break, and we trade for a week, 2 weeks, 3 green candles, we're moving above there, we're taking out previous reaction highs, we're taking out key Fibonacci retracement levels, yeah, then the evidence begins to mount that, hey, guess what? Maybe as grim and gloom and doom as things seemed, maybe the bear market's over. Maybe the Fed pivots. Maybe it doesn't matter what the Fed does. Anything's possible. But right now, probable is that we're in a bear market with more downside to come. So just keep that in mind. That's big picture stuff, right? And then same thing on the Qs. We can go back if we want. We can go back to well, we can go back to the dot-com bubble back there. You can go back wherever you want, play around with these things, but there's the 200-day moving averages taken out when the dot-com bubble popped 2000. Then you tested them for a while, you held them, and then when they finally gave up with conviction, the 200-day moving averages, that was it. And even if you waited at that point, let's just say you're a trend trader and you were making too much money back then in the dot-com bubble, even if you waited till they went and you then got out of your QQQ, your NASDAQ 100, your growth funds, you still, at that point, not even nailing the top, just when we took out the 200s, you still sidestepped, and that's a 78% drop, or you could have profited from a 78% short. And then what happened from there? Well, we went to the next bear market, came back in 07, 08. I'm going to zoom back to that one, and that one was same thing. You rallied up, boom, tried to recover a couple weeks, but remember the S&P was down there, just slightly above it, and two rejections or failed recoveries back above those levels. And then when the markets saw that they just couldn't take back those 200s, then they gave up the ghost. And so here we are today, and boom, perfect rejection off the 200 simple 40-week. And a second near perfect rejection. So you can see they coming together. Sometimes they'll sell the exponential, sometimes they'll sell the simple. That's why I have them both up on there. And that's where we are. So, all right, let's step it down. Shorter term, 60-minute chart. I give you potential bounce targets. I told you last week that at best, if they can, hold a break out of that trend line, it's going to be an overshoot, and we'll probably come on back-to-back test, and that's what I still think. There's plenty of overhead resistance. You can start playing around with Fibonacci levels. You're going to have fibs coming up, Fibonacci retracements. You have plenty of overhead resistance, and quite a bit going on this week with the economic calendar. So that's it. And we're coming off that divergent low, and so so far, we milked, at least personally I did, and I'm sure a lot of you guys did, most of the meat off this bone. Maybe some of you stayed long and milked a little extra, but that's it. I can't carve out every ounce of meat on the bone of each and every rally. Sometimes I do. Sometimes I get in at the bottom, sell the top, but I'm very happy where I'm at now. So staying short for the time being, and I give you some short-term pullback targets on NQ. I gave you the 60-minute chart today. Here's a 10-minute chart, what it looks like. There's that same trend line I gave you. That's at minimum where we're probably coming back to. And so from when I got that post out to you today, that would be a drop of about 2.5% if and when that trend line comes in like that right there. Yep, I think I have about 2.5% drop off today's highs. And that's the minimum target there. Again, minimum. There's potential for a lot more, but we'll probably get a reaction on that level, that trend line, if and when hit, especially if it coincides with other support levels, both on NQ as well as ES, SPY, etc. Okay, so this is the AAII Bull Bear spread. That's the American Association of Individual Investors. This one's probably the most commonly cited sentiment survey. And for those of you new to this whole thing, is sentiment is a contrarian indicator. When the vast majority, and first of all, let me just back up 1 second. It is also, and from my experience, I've said this for years, completely and utterly useless. Do not try to extrapolate any useful information unless these are at extremes. So in other words, you see a spike here, a drop there, means nothing from my experience. Again, you need to see it at extremes. So therefore, it's a sentiment indicator, because if everybody's bullish, then that means that, and especially for an extended period of time, by that logic, everybody has bought his or her last share of Apple and QQQ and SPY, and there's no one else left to buy. Likewise, when everyone is bearish, or the majority, that is, you're at an extreme. That means most people have capitulated, thrown in the towel, and that's when you want to step in and buy. So it's a contrarian indicator, and I've developed levels over the years. It's not rocket science. You can see where you hit these extremes, and that's where everybody's bullish right there, and that's when you want to get out and sell. And then sometimes it's this red line, and again, this is not my go-to. This is the one, again, often cited. I heard it somebody mention on CNBC the other day, everybody's bearish. Well, guess what? Okay, when you look at my green line, in a bull market, yeah, you hit the top of this green level or any spike into it, here, you want to buy, right? These are when you have an extreme, and that's where you had that end of that big multi-year correction back in 2015, 2016, when the big Q4 of 2018 drop hit. Boom, you got your buy signal there. When COVID hit, boom, you got your buy signal. But guess what? And again, I'm in a minority or my own camp that COVID was just a correction. It would have been. It's what I call Ursa interruptus is my term for that. The Fed interrupted a what would have been the start of a bear market for many other reasons and fundamentals, but they just pulled out the nuclear option, and so even though it was a 36% drop in the S&P 500, it was only a correction, a blip. We were right back above there because what the Fed did. But again, it was we had that spike down to there. Now where we're at, yeah, here's what they're talking about on CNBC. But guess what? In a bear market, it's different. You tend to get these. See, you hit it and then you hit it again. You hit it again. You get these persistent, extreme bearish readings. And here you can see. Take a look at this. The only comparison you have for decades is what happened in the last bear market, what I call the last bear market, '07 top, October '07 to '09 lows, 55% in both the S&P and the Nasdaq drop, and then you had extreme spikes, and they just, they get bearish, they get a little less bearish on the bear market rallies, and it wasn't until they completely puked up all the last of the weak-handed longs, were shaken out and just couldn't take it, and you had such an extreme drop. But again, that was for over a year. Actually, we started hitting it back, around the top of the market right there. The first signal was back in late '07, and you can see it happened for a long time. So in other words, this is to me, there's some useful information. It shows where we're at, but it shows me that this is more indicative of, again, the last bear market. So, for those folks who are telling you that everybody's too bearish right now and that's why stocks must go up, okay, that works in a bull market. If you believe we're in a bull market and this bear market's over, then great, go ahead and buy on that. I don't, so therefore I'm going to show you what and I've talked about for many years, my favorite sentiment indicator, not talked about as much on the media, but this is rhetoric here. In other words, when you do this, the way it works, they send out a weekly survey to all the members, AII, and they say whether they're bullish or bearish, and whether they expect stocks to go up or down in the next, I forget whatever time period. And so I've said this often. I may be a bull in rhetoric. I may say that I'm very bullish. I think the market's going to rock. I plan to buy stocks. But guess what? I might change my mind. So it's one thing to say you're bullish. It's another to actually lay your money down on the line. So this is where people don't necessarily have to put their money where their mouth is. But here's where they're putting their money. And that is in these various put to call ratios. This one's the CPCE, which is the equity only put to call ratio. Some of them include indexes. There's an index only, and I use them all, and I have the same thing. I have levels here, and again, while what this shows is this isn't people planning on buying puts or planning on buying calls or saying they're bullish or bearish. This is where they're actually putting their money. And so this to me is a much more accurate indicator. And here, let me give you a different variation of this one. I might have the levels marked here. There's one there. Well, we can start with this one. This is the CPC, the total put to call ratio, includes equities, indexes, everything. And you can see my green line right here, excessive fear. That's when the put to call ratio is high. You wait for, so you can note here, it's not just, don't just buy a spike to that level. Once you get a spike to that level, it shows you market conditions, that there is excessive fear. Then you want to wait for a buy signal, and you can see that these often correlate with major bottoms that come right after that. You can go back. There's COVID, right? Yeah, told you to buy there, and wait for buy signals. There was that fourth quarter drop of 2018. There was a big drop, big spike into it there. And then look on the bottom. This one's even better here. The extreme complacency, but wait for sell signals to longer go short. And what these little boxes are I have here, these are what I call clusters. That's why it's not a one tag and then you close all your longs, turn around short, you'll get killed. You look for persistent readings, and then once you get the major readings that proceed a top, and that can proceed by months. If you want to know when a bear market is over, none of the bear markets I've ever seen have ended without a spike into here, and we're not even close. This is just telling me, despite what the AI is saying, there is, I'm not going to say there's no fear in the market, but there's not excessive fear, not even close. And you can see where we've spiked to in the past. So that's the CPC, and let me show you the CPCE. I have the same thing done up for you somewhere. There it is. This is the equity only put to call ratio. Look at this thing. I mean, it's pretty dang accurate. This is where you want to buy when you see these spikes here. These were the two best buying opportunities in many, many years, the end of the fourth quarter in 2018 and when COVID hit. Then you had a very good one back here. That was also a sideways market for about a year and a half there, really. We went and had a couple big corrections. Once it was over, we had a very strong run. And those are the only times, other than, look, right here. That was the end. That was the end of the bear market in '09. March of 2009, start of a new bull market, and it came right after that spike there. So you have zero failures, zero. You have 1, 2, 3, 4 tags that green level. That's when you want to buy. And when you're in a bear market, if you want to really know the bear market's over, there are no guarantees. But if you get up to that level and then the charts confirm, let's say we're at my fourth target on the QQQ weekly chart or something like that, that's where I'll be taking my 401k, going from cash to full-blown equities at that point, or at least around that time starting to scale into a full-blown equity. And you can see here, this is pretty reliable too on the downside. Extreme bullishness. So right there you had a spike into my red zone right there, and I put the arrow where it was right before that was the biggest correction in the bull market after it started, and it was double digits, well into. Then you had another one right there. It nailed that one right there, got you out before that big correction. Then you had one right here. Remember, this was a year and almost 2 year sideways market with multiple corrections ranging down to close to about 20%. And it said get out and stay out. Or again, the charts would have told you how long to stay out. And that was it. We didn't touch that level to here. And after COVID, we had, again, and I talked about it, these are clusters. It's not a one and done, especially when you come off the bottom there, but you started getting extreme bullishness. And as I say, these are conditions, and these conditions were unseen before you'd have these spikes. Therefore, there's a price to be paid for all this, and I think it's with a lot more downside to come. But either way, look, we're going to trade, as you know me, I'm going to drop, bear market, bull market, I'm going to trade the counter trend rallies. I'm going to use the 60-minute charts and even the 10 and the 5-minute charts, and I'm going to trade the zigs and the zags. I just want to make it very clear, in my opinion, that this thing didn't even come close. So whatever fear they talk about out there, again, that's rhetoric. It's not where people are actually placing their bets, and institutions as well, by the way, institutional traders. So that's it. Let's move on. Short term, I'm probably spending more on the equity markets. Well, because I went into the sentiment indicators, but there's that big 311-ish level right there, and that's where we're at. And here's the example I want to give you. So let's just say right now you're cursing my name because I told you I was going to stay short, and I'm still short, and I'm still expecting to go down, and I was going to give it a little room past the trend lines and all that. We're up a whopping 8.085%, so less than 1%, about 0.8% up on the Nasdaq today. And that in addition to what we were up on Friday, right? So so this my current short trade's getting underwater here, but hardly by relatively speaking, not much. And then you look at the other things out there right now. If you were trading only the Nasdaq 100, then guess what? Or only the indexes, and you were short, then you're not happy today. You're not happy in the last 2 days. And you're down, and you're probably second guessing your position. But if you're diversified and you have gold, silver, lumber, natural gas, crude oil, well, your lumber trades up 10% today right now, in addition to the previous 10 that it already did since the breakout just a few days ago, 4 trading sessions ago. So there's one. Like I said, that's it, close enough. It could certainly hit that level or go through it, but that's a big resistance level, 567.20. So when all I see it, what tends to happen is the sellers will step in early, and so again, that even if, and as you should have, lumber's more volatile than the market, so you do have a beta adjustment to your size. In other words, you don't typically, I won't take as much in a position of lumber as I will in the Nasdaq 100 or S&P 500 because it's more volatile, can go up or down more in a single day. Here's a good example, 10%. But even if you put half in, let's just say, then net you're up. You're up. We'll even round up the Nasdaq 100. Say it's up 1% today, which it's not, but we'll just say that. And I think at the high it was close to it. Then you're up 10 times that in lumber. Even if you took a half position, then you're up 5 times what you are in a Nasdaq short. So that's lumber again, close enough. Move on to the next one, and then silver. This is up over 6-7 times what the Nasdaq 100 is up today. It's up 5.4% silver futures. As I pointed out, got charts out too. Yeah, we're at resistance, and so and we had the euro rally into resistance as well. Nothing goes up forever, so probably get a little pullback. I gave you levels, and now I wouldn't get cute trying to game these pullbacks. I'd be more meaning I have no desire at this point in time to short in reverse in silver and gold. I'll just, if I have any more room to add, I've got a pretty good chunk of both, but I would be more concerned about just adding on pullbacks to support, building a position if I didn't already have a full position. So anyways, those levels are about 1950, then 1895. Again, you have the chart, and you want to see obviously a breakout above that level. There's resistance, minor resistance, 1994. Targets 2070-ish, 2254, and then gold as well. Gold's got a way to go. I told you silver, tends to outperform when you get the call on the metals right. Silver is almost like just a leverage play on gold, just like the miners are, GDX. And there's gold. Put in that double, triple bottom, positive divergence, bullish falling wedge. But at resistance. So you see, next stop here, 1771, and the trend line. Maybe a little pullback, maybe not. Break out, whether you do or get a pullback or not. Break out above the trend line, especially a solid breakout, especially if it's not extremely oversold at the time or with divergence. Then you're likely to run up to the 18 level, 1811, and 1896, 1944. Yeah, and I haven't cleaned up my GLD charts. Time to time I try to remember. A lot of you don't trade futures, and that's fine. For me to be bullish on GC gold futures is to be bullish on the ETF. Obviously, they're going to track almost perfectly. But there's a 60-minute chart of GLD with a little wedge breakout right here. Minor resistance that needs to pop through about 160, 156. And although I haven't updated this chart in a while, that's still, there's a little stop along the way here. I'm going to pull one of these old lines, put it right there. Yeah, first stop or first resistance, 163.80, and then 167.88. We'll call it 168. So those are your near-term targets for gold right there on the ETF. And then the daily chart. Remember, this is much, much more important than what I cover on the 60-minute chart, or especially if I go down to a 5-minute chart or a 10-minute chart. This was and has been for over a year now, for almost 2 years now, a buy zone that I laid out back here when I got out of all those long-term trend positions and put some shorts on gold, expecting to pull back, and boom, 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 we just hit it again. Every time we've hit this, there's been a big, nice tradable rally off on gold. And then, obviously I've talked on it. Allow for a little bit of a false breakdown. That's fine, but I wouldn't hold out for that because we may never get it. And so far we're reversing. We back tested the trend line, so it looks as good as it can get. Positive divergence as well. It's one thing to fall to that level, all the better when you can fall to a key support level with bullish divergence on the daily chart here. So me likes gold. No two ways about that. Silver, same thing. Positive divergence, aka bullish divergence there. Been building for a while now. And like I said, gold's moving up, so silver's moving up even more. Up again, whatever, 5.25% today. And then it's all about the euro. I probably more so than I don't know. I really don't follow anyone else out there, but you know me. I'm hyper focused on the currencies when I trade gold and silver, because if you can get a rally in the euro, which is the same thing as a drop in the dollar, um, then that just helps to make a case of gold will rally. So there it is. You have this bullish falling wedge on the daily chart. uh, Highlighted, got it out to you a while ago. We're at that, at the wedge, so obviously a reaction, which is what we had today so far. You can see we hit the top of the wedge right there and had a little bit of a reaction off it, but we pulled back to support. And so, I don't know if we're going to have another, thrust, take a while to break out, or if we can power on through and break out now. All the better if we do. But what I can tell you is once you break out, especially a solid daily close above that, and then a second green candle the next day, is a pretty big breakout, and that's probably going to be the catalyst. There'll be some stops along the way, but then you come to the primary, larger downtrend line. If that happens, that's going to be quite bullish for gold and silver there, especially if crude plays out to my downside target. I'll get to crude in 1 second. So that's it. And then the 60-minute chart, I got this out to you this morning as well. I showed this bullish falling wedge on the 60-minute time frame recently. It's different from the one on the daily. The daily, remember, we just hit the top of the wedge. And these were the levels I laid out where reactions were likely, and that's what you hit. You hit my 1.01133 level, had a pullback, hit it again, a little smaller pullback, then we took it out, went up to the next resistance level I had there, had a pullback, and we pulled back to, resistance once broken becomes support. So ideally, if we can hold here, but we don't, there's plenty of room. We can go back and, maybe come back, hit this uptrend line. I don't know exactly if we bounce here or not, but all I can tell you is it's bullish that we've gotten back into that trading range. And as I said last week, once you enter one of these ranges like this trading range, it's boxed in right here, you tend to go to the top of the range once you re-enter it from the bottom at least. And then, of course, if you can break out above the top, all the better. Okay, USO. Certainly not liking what I'm seeing today. In fact, I will most likely begin scaling out. I'm going to give this thing at least till the end of today. So I'll see today's close. I can watch a futures overnight because I'm in CL. But right now, we have regained that 70. Remember, I had 71 support. I have a support zone. This is what gives me pause. We had the positive divergence, and now we're reversing, and the PPO hasn't yet crossed. See, when it crosses right here, when the PPO line moves above the signal line, then it will be what I call confirmed divergence, because you will effectively put in a lower low. They're momentum indicators. Sometimes they look like they're going to cross, but then you keep going lower. I would love to see that divergence get burned out, for the case, for the, current short trade. But like I said, things are whippy. This market's plagued with whipsaws. But like I said, right now, here's the thing. If I didn't have any position, would I short crude now? No, because we're back above support. I would wait for a rejection here, a failure, and let this prove to be an intraday or a one-day whipsaw maybe, even if it takes 3 days and then we drop down below there. Once we go back down, then that would just be a shakeout move, what we call a whipsaw. And so that's what you need to wait for. Now, if you want to give it room, great. If you don't want to give it room, you can be a mechanical trader. We've regained support, stop out. You can always get back in if we fall back down there. But like I said, as of now, not looking good because you still have that potential divergence in your above support. So I'll give it a little room, but not much more. And then on UNG is still fine from a technical perspective. We're still well below, we had multiple sell signals in here and here, and we hit that first support right there, 27.54. This is UNG, the nat gas ETN. Flag is getting foiled now, so I'm not crazy about that. Remember I said we had a potential bear flag. This green candle day is a little too big. If it goes up much more, you can keep that flag intact now. But most importantly is this thing's still very profitable. And you have a gap right here, and you have to look at the, which I'll do right now for you, look at the chart of the future. See, there's still this downtrend line. This is a hourly chart. There's our downtrend line right there, and there's quite a bit, some pretty good price resistance there. So there's plenty of upside in the near term for natural gas to keep this bearish case intact. But this is about the level here, about 80. 88.82 or so. Once it starts getting much above there in that trend line, it starts to call in this downtrend into question. But again, depends if and when you took this thing, where you shorted, where your entry was. So like I said, everyone's stop is going to be based on where they entered, how much, what their trading style is. Some people love to run tight stops. I've always said this: if you run a tight stop on natural gas, meaning 3-5%, don't even bother. They're going to take you out on the intraday swings. You need to use wider stops. And if you're targeting, again, if you're going for the juice, the big drop, which is, go back here to this yearly chart right here. This is what nat gas futures looks like when I go to a 1-year chart, daily candlesticks. You had a big bearish rising wedge, a nearly 50% drop when that one broke. There's our other one. And so from this perspective, it looks fine. You just came up on the first support level. You're having a reaction. I could easily see more upside or not. The thing about nat gas is usually it finds a point where it's this darn thing's either going up or down. It's usually full throttle either way. Sometimes it will go into periods of consolidation, but lately it's either been you want to be long or short. Very little in between. You can see usually when it drops, there's counter trend rallies, but they don't last very long. When you're a bull trend, same thing. That's it. I mean, I'm for now still maintaining that target. Like I said, it's hard to say how much more upside, if any, this bounce has. But as of now, nat gas looks good, and I already shared my thoughts on crude. So let me make sure that's it. Yep, that's everything I wanted to cover. All right, guys. Let me get the video out to you, and we'll see how today closes, and we'll go from there. This has been Randy Finney with Right Side of the Chart. Have a great day.